each other. That's awesome. It will be an awesome experience. I hope many of you are going to join next year.
Probably.
Probably.
Yeah, definitely. I mean, it's
Okay, Victor, are you on?
I am on.
Okay.
Can you
turned off
can,
your video? Okay,
can,
good.
can you
I
see
will
me?
assign all of you guys to.
Before you assign us, can you just give us a quick just some tips on since you've done, as you said, that you've done for 15 years. Anything that you said, listen, try to streamline the presentation. Any tips that you might give us?
Just enjoy it.
That's awesome. I like that.
Just enjoy it.
I like that.
It's a great experience. Just enjoy it.
Okay.
Thank you.
Thank you.
Yeah, go to the room.
All right.
Good morning. Is it? Oh,
Morning.
Good morning.
Good morning.
so it's a team of 4?
Yes.
It is.
Yes.
Okay, judges, could you introduce yourselves first?
I'm Chris McHugh. I'm at Tufts University.
My name is Elizabeth Curtis. I teach at Dartmouth College.
Okay, students, it's your turn.
My name's Cameron Merrill.
My name is Victor.
My name's Brian.
My name is Becca.
Everyone can hear clearly?
Yes.
Corset?
Yes.
Okay, you have 15 minutes presentation. I will measure time. So you will have 5 minutes and 1 minute warning. After that, 10 minutes Q&A.
Okay.
If you are ready, share screen and you can get started.
Okay. Just let me one moment while I share my screen.
Mm-hmm.
All right. Can everybody see the screen before I proceed? Great. Good morning, fellow committee members, and welcome to today's meeting. I'm Cameron.
I'm Victor.
I'm Brian.
I'm Becca.
And for today's meeting, we'll be discussing our dual mandate, including evidence that inflation has been cooling over the past few quarters, and the high rates are disproportionately affecting different sectors and minority groups in the labor market. We'll then present the risks of over-tightening on economic growth, and then analyze the effectiveness of our current policy and provide a recommendation of maintaining current rates via neutral policy to avoid over-tightening and damaging the economy.
An important part of the dual mandate is maximum sustained employment. And by using the proper tools, we can get a clear vision of the economy's current situation. By using the correlation between U3 and U6 unemployment, we're able to assess the effectiveness of our current policy and forecast the economic's behavior. By using 2019 as a benchmark of the optimal state of the economy, the goal for the past few years has been to get us back to 2019 levels. And as you could see, U3 and U6 have receded to pre-pandemic levels. This shows how effective our policy has been. Another great tool at our disposal is the labor force participation rate. This indicator allows us to measure the health of the economy. And as the Congressional Budget Office states, a lower labor force participation rate is associated with lower GDP and lower tax revenues. It is also associated with larger federal outlays because people who are not in the labor force are more likely to enroll in certain federal benefit programs. And as we could see in the indicator, we have had the greatest LFPR recovery since 1955. The weekly insured unemployment claim is also another tool that we could use, and it shows an inverse relation to the LFPR and proves the trend to be true. As the graph shows, we're back to pre-pandemic levels. To further analyze the current state of the economy, we dissected the economy by supersectors. Our research revealed our current policy has been effective in all supersectors. But while unemployment in the information and financial supersectors are still on the upward trend year over year, manufacturing, leisure, and construction are starting to fall back to previous levels. This can be due to government and private sector investments in AI and EV, the lacks of travel restrictions, which caused a booming travel demand, as well as the diminishing labor market. Also, when we analyze the Phillips curve, which is sometimes a contradictory tool. This time around, we could use it to present a short-term inverse relation between unemployment and inflation. With that being said, we have seen that in the past year, that even though inflation has decreased from 8% in 2022 to 3.7% in 2023, unemployment has not been greatly impacted. In fact, unemployment has been marginally stagnant and the labor force participation rate steadily increasing. Government incentives and market innovations can be largely attributed to the high demand of jobs in the supersectors of manufacturing, leisure, construction, and transportation jobs. Now, the key takeaway of employment is both U3 and U6 have preceded to pre-pandemic era. The spread between both is smaller, showing a tight labor market. Now, history has shown us that keeping rates high for an extended period can destabilize the economy, potentially causing a deep recession. So, if we continue to rise interest rates, a hard landing may be inevitable.
Great. So the second aspect of our dual mandate is price stability. The core PCE for August came in at 3.9%. While this is still far above our current target of 2%, it's important to recognize that downward trend that we see towards the end there. And based on this data, we expect the September PCE, which will be released on October 27th, to continue to show this disinflationary change. This trend is consistent with the core CPI, which came in for September at 4.1%. Additionally, looking at University of Michigan's inflation expectation, we expect numbers as low as 3.5%. Looking at the core CPI and the core PCE, it's obvious that with the exception of some months, the trend is strongly disinflationary, signifying that previous rate hikes have actually begun to show those positive results. Additionally, with the apparent lag of response between the rate hikes and inflation, we expect further economic cooling in the future as a result of these previous rate hikes. Given the data that we've observed, with inflation already on this downward trend and the effective rate at 5.375%, it would be harmful to proceed with tightening the economy. It's important that we err on the side of caution to avoid a hard landing, as we mentioned in previous section as well. It's also important to take a look at price stability by sector. Most major sectors, such as medical care and food and beverage, follow the trend of the core CPI towards that 2% target. These are the sectors that are more directly affected by these rate hikes. On the other hand, the housing sector, for instance, is only marginally affected by raising rates. Many homeowners are locked in at those mid-pandemic low rates, making them unable to afford purchasing a house of similar or higher price in the current market, with average 30-year mortgages around 7.6%. So that's why we see these very high real residential prices. Homeowners are only willing to sell at these high prices. In fact, they're the highest prices in history. This offsets the effects of the decrease in demand from limited borrowing, causing a disconnect between rate hikes and disinflation in the housing sector. And what we see here is that the spread between the core CPI and the housing market CPI is actually increasing as rates increase. So based on this data, we expect the rate hikes to actually have diminishing effects on the housing market. By continuing to raise rates, we'll be effectively damaging those highly responsive sectors, such as medical care services and food and beverage, and only be marginally affecting more resistant sectors, such as that housing sector. Additionally, we must look at the effects of the supply side of the market on our inflation. Over the past year, worker productivity has increased immensely, while rising wages have cooled. The relative cooling of wages and upward trend in productivity allows businesses to pay less for each unit produced, leading to a decrease in prices. As you can see, there's a direct relationship between wages and the core CPI and an inverse relationship between productivity and the core CPI. Based on this data, we expect the supply side of the market to continue to disinflate, decreasing the need and increasing the risk of over-tightening.
Next, we will be analyzing the measures of economic growth. The United States trade deficit indicates a plus for the U.S. economy. While the trade deficit has been narrowing, it still remains far wider than pre-pandemic levels. The contraction in the trade deficit that we are seeing is attributed to a more rapid decline in imports compared to exports, which may be signaling a potential slowdown in domestic demand. Residential investments fell 13.7% from a year ago due to tightened mortgage lending standards and diminished demand. However, the surge in non-residential investments driven by transportation equipment, manufacturing structures, and software has more than offset this downturn. We expect this disparity between residential and non-residential investments will continue until rate cuts in the future. In 2022, the net domestic investments reached pre-pandemic levels. However, since then, there has been a consistent decrease in the value of business investments. This decrease in investments may suggest an impeding economic slowdown due to businesses possibly anticipating reduced demand or unfavorable market conditions. U.S. real GDP rose by 2.4% year over year during the second quarter of 2023, above 1.8% year over year in quarter one. The consumer sentiment is displaying mixed signals. While there's improvement signaling a move towards recovery and potentially increased economic activity, the absolute level indicates that there's still a way to go before consumer confidence is fully restored to pre-pandemic levels. Consumer loans have surpassed pre-pandemic levels, which is attributed to the high inflation levels causing consumers to have to borrow more money to cover their financial obligations. While high consumer loan growth is indicative of increased consumer spending, which represents the resilience of economic growth, however, there are some risks that may arise when over-leveraging occurs, which can have detrimental consequences, particularly if an unforeseen economic downturn occurs. This would then compromise the consumer's ability to meet their debt obligations, resulting in them defaulting on their loans. Over the past 2 years, the growth for retail sales have been trending down, which is strongly impacted by the high levels of inflation, which was illustrated earlier on the Consumer Price Index. Due to the high levels of inflation, it has caused consumers to allocate a larger portion of their budget for essential items like food and housing, which ultimately leaves less disposable income for retail spending. The growth rate for new orders of durable goods was recorded at 3.6% year over year in quarter two, presenting a decline when compared to the 8.5% year over year growth experienced in quarter one. The decline in growth hints at a cooling down of demand attributed primarily to inflation, which increased the cost of borrowing. Lastly, I'd like to present to you the Fidelity Business Cycle graph. This chart supports our research on the current economic outlook. According to this graph, we are currently in the late stage of the business cycle. It's evident that the recent fiscal stimulus only extended this late cycle phase. However, as the late stimulus's impact starts to diminish, various indicators hint at an economy that's beginning to cool down, shifting us towards a potential recession. One of our main concerns is that over-tightening could lead us to a severe recession.
Next, we will cover the effectiveness of our current monetary policy, followed by our policy recommendations. When the pandemic caused a recession in March 2020, we engaged in quantitative easing to swiftly bring us out of the recession. We lowered the federal funds rate close to zero, massively stimulating the economy. Although initially successful, there were a number of trade-offs. Inflation rose far above the 2% target and has remained above target for nearly 2 years. We are currently implementing a series of rate hikes to tighten the economy. By restricting the monetary supply, we are curbing inflation. Our current policy prioritizes bringing inflation down to our 2% target. At the 2023 FOMC meetings, we usually raise the federal funds rate. Currently, the federal funds rate sits at 5.25% to 5.5%. By tightening the economy, we are effectively slowing inflation. With that being said, the data we have observed suggests that continuing on this path of tightening will come with high risks. When we raise interest rates swiftly and steeply, we risk over-tightening the economy. Our analysis suggests that elevated interest rates successfully temper demand in sectors sensitive to interest rate fluctuations, and that we anticipate this trend to persist. Also, it's crucial to understand that rate hikes have a limited effect on supply-driven inflation. For instance, we witnessed supply chain bottlenecks in the early phases of this inflation cycle, which have now started to ease. Rate hikes also have a limited impact on less interest rate sensitive spending, such as investments under the Build Back Better initiative. I will discuss our policy recommendation in response to the apparent risk of over-tightening. Here is our monetary policy recommendation matrix, based on our research. Considering current data trends in inflation and GDP growth, we categorize this scenario under moderate inflation and moderate growth, according to the table. We recommend a neutral policy which maintains current monetary policy settings. It is crucial to consider potential repercussions of over-tightening monetary policy, which include further maintaining high rates for extended period, could precipitate systemic risks with small banks and small businesses, mirroring the financial crisis of 2008 and potentially creating a recession. Therefore, a balanced and cautious approach is needed to navigate the economic landscape and avoid the adverse ripple effects of over-tightening. As part of our neutral policy, we recommend that for this FOMC meeting, we hold the federal funds rate at 5.25% to 5.5%, reflecting on lessons from the 2007 cycle when we maintained high rates for an extended period and inadvertently contributing to the refinance crisis. Given this historical context, and as time goes on, we should either maintain the federal funds rate or gradually lower it, depending on the state of the economy at each meeting. We will depend on the data and formulate our policy from there. We must be cautious around high interest rates because they can generate a refinancing crunch. March 2023 highlighted that around 90% of single-family residences have fixed-rate mortgages, and over 2/3 of auto loans are locked in at lower rates. As for businesses, most investment-grade corporate debt has fixed low rates. As companies with weaker credit profiles default on their loans, they likely require refinancing at higher rates. A mass defaulting on loans could trigger a domino effect, unnecessarily straining a vulnerable banking system and especially impacting smaller banks and businesses. We must continue to monitor the economy closely and exercise caution, especially with small banks and small businesses. Because small banks and small businesses are interest rate sensitive, they cut their spending when high interest rates make consumption expensive. Thus, high rates make them more prone to default on their loans. Our research shows that the small bank loan default rate is increasing, exceeding the previous 2 recessions. Thank you for your time, and we look forward to your questions.
Thank you. Now, judges, it's your turn.
Thank you. It was very good. Let me start you with one kind of basic question. You mentioned the Fed rate raising policy, but what about the other major Fed policy / thrust that it's been engaging in since last year? Do you know what I'm talking about? And can you tell me a little bit about it? I'll give you a tip. I'm talking about the quantitative tightening. Can you describe that? The balance sheet reduction project.
I know
Okay.
a little bit about the balance sheet. I know that quantitative ease. So when the pandemic began, when the pandemic hit the U.S. in March 2020, and we had quantitative easing, that involved increasing the size of our balance sheet. And now that we're engaged in quantitative tightening, we are reducing the size of our balance sheet. And at the 2023 FOMC meetings, when we raise the federal funds rate, we also are choosing to reduce the size of our balance sheet, which is quantitative tightening.
Okay, that's about the thrust of it.
Okay, let me ask you sort of a more principled inflation question, because I definitely heard from your presentation you were much more worried about a hard landing, and you talked a lot about the details of inflation. Can you give me sort of a basic understanding of why it is that inflation is such an important, price stability generally is an important part of the Fed's mandate? Why is inflation costly? And a little bit about why it seems from your recommendations you're discounting the fact that the Fed hasn't hit the 2% target.
Yeah, absolutely. So the importance of talking about inflation, it's mainly we're talking about, price stability. So how much things cost, to put it plainly and simply. So when things cost a lot of money, that can cause a lot of issues for a lot of people. And it can also influence a lot of disparities inside of our economy. And what we see is that it can be different for larger businesses versus smaller businesses, and higher income versus lower income families. And what we're seeing with those lower income households is that they're not able to really, survive this inflation cycle where we have to raise rates so high. They don't have those large amount of savings put away. So when we come into this inflation cycle and we're raising these rates to try and temper this inflation, it's really those lower income families that are having the worst run of it. Whereas like the middle income families have some of that money put away. they're able to sort of survive this cycle using those savings they have, their steady income that they have along with that. Additionally, when we talk about price stability, we are generally talking about additionally how much it costs to borrow money, because that comes down to the raising of rates. And when rates are so high, it does also dampen economic growth, because what can happen is people can't borrow, businesses can't borrow, and a big part of expanding in a business is being able to take on a good amount of debt. So overall price stability is, we do talk about it as one of those most important things in the economy, because it does affect almost every sector of the economy in terms of, from large businesses to small businesses, but also affects every individual, from those lower income households even to those higher income households as well.
If I could also piggyback on my colleague Cameron, one other first, stressing on price stability for the lower income specifically, because they are the ones that occupy the lower wages. They make less amount of money, and if prices are unstable, they are not able to afford as much as what they could. And usually, we've seen people living paycheck by paycheck, and if they can't afford to buy what they used to buy with their money, then that creates a lot of distress in the economy. And not to create a rabbit trail over this answer, I'd also like to mention that it's also important for trade. Because if prices are unstable, then also the exterior market that buys material from us also suffers that, because there's no stability on price. So I think that the mandate that we have in focusing in price stability is a key thing.
Thank you.
Let me ask, you mentioned super sectors. That's new jargon on me. Are they sectors like are they better sectors? Are they better for minorities, or what's the character? Are they bellwether sectors? What's the meaning of super sector?
Right. So super sector, it's kind of if you think of a family tree, they're like the parents of the kids. And then the kids have kids, that's the grandkids. So it kind of breaks down. So when we talk about, say, the financial, then it includes everybody that works under that, such as, say, an actuator. He is embedded into that super sector. When we speak about construction, the super sector of construction, it boils down to every single trade under construction. So that would include the plumber, it includes the electrician, it includes the roofer, it includes the builder, it includes the architect. So it kind of boils down. So we kind of, because our presentation is so limited, we had the data to go into details and go and by sectors and then subsectors. But because our time is so limited, then we only took a look at the super sectors to give you kind of a broad view of how the economy is doing.
A quick question that I have for you, and you've done some of this already, but where do you see the really worrying soft signs in the economy that might lead to your hard landing that you want to avoid? Where are the real? Can you sort of summarize your soft signs, the things that you're really most worried about?
Yeah, so when we're talking about the hard landing, there are a few things that we're mainly worried about. One of the big things is that on the supply side of things, we have worker productivity going up currently, and that's the long-term trend of that is largely due to technological advances, things of that nature. It's also due to the mitigating of the supply chain disruptions that came from the COVID-19 pandemic. So with that production going up, we do see a downward pressure on prices, and this is even more amplified with wages sort of stabilizing at this point in time. We saw about 4 million people leave the job market recently, and we had about 3 million people come back in. But those 3 million people were immigrants that require lower wages, lower skilled. So again, this is more downward pressure on prices. When we pair this with those rate hikes, which have already caused a very aggressive downtrend in inflation, we've seen this downtrend of inflation over the past 6 months be very strictly downward. We don't want to sort of hit things with two bats at once. We're not in control directly of that supply side, and where it's already naturally disinflating the economy, and we have already begun to disinflate the economy via rate hikes, we don't want to over-tighten Another part of that is we have this lagging effect, right? So we don't know, directly which rate hike affected which disinflation measure. So we kind of have to tread lightly there. And that's why, part of our policy is staying neutral and, keeping rates steady for the next couple of meetings and monitoring the economy from there, letting the lagging effect sort of run its course. And be able to analyze what is going on from there on out, and then make more of a decision based on that data.
Cameron, if I could just piggyback once again, I know we have 1 minute. So as Brian extensively showed on his presentation, I want to stress that we lost 4 million jobs, but we also gained 3.5 million. And that gaining of the 3.5 million, if we look at the graph, we could not include the graph here, but if you guys wanted, we'll be glad to send it to you. Already shows that the wage is already going down. So if we keep on raising interest rates, that as Cameron said, then probably a hard landing will be inevitable, because we already see that the trend is already going down. And with the lag effect that we're having between 6 months to a year, if we keep on raising interest rates, then by the time that we lower it, say, the next 3 months, then it might be too late, and then that's when we'll fall into a recession. So that's what we're trying to avoid is.
Yeah, if I could add to what you just said, Victor, if we are able to flatten the wage growth along with cooling inflation, it will help us keep a moderate pace to economic growth and avoid a hard landing.
If I can just chime in, can I clarify just a second? So are you saying that the softening in the, where you are seeing the actual warning signs in the economy directly come from the labor market? Is that an accurate kind of overview of what you were trying to say?
That definitely contributes to that. Definitely contributes to it, yes, because we're seeing the disinflation in the labor side of the economy, and we're also disinflating it via the rate hikes as well.
Can I mention also one last thing? If you look at the graph when we worked on a super sectors, you will see that leisure, transportation, and construction is already trending down. But yet financials, they are still trending up. So that also shows that the Fed's policy of high interest rate is not affecting everybody as a whole. And the issue with that is people in the financial sector, they usually are people that make, they tend to make more money. So they have the buffer of savings. But if we continue to do that, then we might cause distress in those sectors.
Okay, time's up. Judges, any brief question you want to do, or you okay?
I think I'm okay.
I'm good, thank
Okay.
you.
Okay, thank you
Thank
guys,
you.
and
Thank you very much. This
Great
was-
job,
Good luck,
everybody.
I must say, this was much easier than I thought it would be. Thank you, guys. Thank you.
So much.
Thank you. Take care.
Good luck.
Thank you.